Okay guys, so since Monday, Cardano's ADA has fallen by 14.94%. It's a pretty reasonable move to the downside. This is in line with kind of our upper areas of expectation. And well, with this move to the downside, in the last technical analysis video, we were talking about the potential for 72.9 to 72.23 to 75.22 cents. That's this yellow box area just down here. You can see that we tapped this briefly at 1400 hours on Thursday. We bounced back to the 50 EMA. Then we came back down here at 2300 hours, back to the EMA, and then back down here most recently at 0200 hours UTC, and heading back towards the 50 EMA and 50 SMA 200 EMA on this 1 hour time frame. Now, as we kind of reflect on everything that's going on here, let's go ahead and take a look at what our expectations need to be based on this last retracement. So take this measurement from the kind of 2300 hours low and the 1700 hours high on Thursday, move this over to the bounce to the upside that we had here on Friday at 0500 hours. And you can see that we would be looking for 73.3 to 74.28 on this low side, again, creating this little bit of overlap just down here into this lower range. No coincidence that this price moved down into this range and then started to move back up. And right now, again, our concerns need to be that we look for resistance on the 50 EMA, 50 SMA 200 EMA. Okay, so let's go ahead and take a look at what that looks like. So I'm going to draw this in so you guys can see the A, the B, and the C. Okay, this then falls in line with this kind of bigger move here that we could see, and is still potentially a area of concern that we have to have when it comes to price action. So 0500 hours on the 16th of May. Okay, that was a swing high of 78.59. On the 16th, so again, yesterday, Friday, 1100 hours UTC, we had 78.54. Okay, so we are slightly lower here on this area. So we have this little B wave here, for example. That means that this is a very much an impulsive move, an impulsive break to the downside, but does create overlap between what would have been wave 2 and wave 4. Okay, so this would mean that we'd be entering into diagonal-based territory, which is perfectly fine and perfectly normal under these circumstances. So what I'm suggesting is that there's still a possible breakdown to happen here where we have to come down a little bit deeper. Now, all of this is a concern because it puts us into a potential move to the downside, again, with a diagonal-based pattern over here. Okay, let me show you what this looks like. So you'd end up with 1, 2, 3, 4, and 5 like this. That then leads us into a bigger wave 3 situation, which is what we saw down here, the wave 4 coming up, and then another diagonal into this 5th wave movement here. Now, this in itself can be a little bit alarming and a little bit concerning when we take into consideration this initial move from the 12th of May, 1300 hours to the 0400 hours as well on the 13th. We take this movement and we put it over to here, our original kind of start position, and you can see that we have come down into the typical areas. Anything deeper than this is going to kind of be a little bit irregular, but I also don't think it's going to cause a huge problem. And the reason and the logic and the rationale, and as long as we stay above 70.1, I think we can call it a flat correction, 335. We don't have the 5 wave structure points that we would normally expect to see over this side. I'm going to do some checks though, just to make sure that I'm not just, assuming the best case scenarios. If we take a look, that's a 1-to-1. So again, that's actually okay. So wave 3 being greater than wave 1 in that particular example. Wave 3 here, and wave 5. Well, wave 5 would be shorter. So it doesn't really reach a lot of those kind of expectations of diagonal. So I don't think this is an impulsive breakdown where it's a trending move to the downside. I think it's very much a corrective one. And I think although we might end up overextending above and beyond, to 73.2 to the downside, I don't think it's actually going to be a big kind of area for sounding alarms. I think ultimately it's going to be okay. So Let's go ahead and take a look at what this could mean then for ADA, because it could mean that we actually have, a move down towards 71.67 at 72.81. Okay, somewhere in that range. I'm going to put another yellow box down here just to kind of just show you what that might look like for that final movement within our fifth wave. Okay, it's a little bit lower than our initial expectations. Now, if we take a look at this stochastic RSI, it's overbought here on the 1 hour time frame, oversold on the 4 and 8. So we could expect this move to the downside over the weekend and then rallying either later tomorrow, Sunday, and into Monday, or Monday rallying and breaking out of this bearish structure that's currently in. Take a look at it from a relative strength index perspective. We're lower than 50. There was lots of hidden bearish divergences as we were hitting those areas of resistance. Right now, we could see something similar. So it would be interesting to see whether or not we have higher highs here on the relative strength index. If we do, whilst having a lower high on the price action, when that is going to be bearish divergence. So we want to be aware of that as well. I think ultimately we should be thinking more of a move to the downside, which is the opposite of what I was saying on, I think, Thursday. So here we could be looking for this move here to look for 1.5 risk reward ratio on a short position, stop loss higher than a previous swing highs and above the 200 EMA, 50 EMA and 50 SMA. And so we should potentially be thinking shorts rather than longs at this point. Taking a look at the MACD histogram, the MACD histogram grew quite a bit here, showing that there is, of course, a little bit more sell pressure, coming in. Again, we can see slippage to the downside when it comes to the green histogram, basically showing that there was weakness as we were coming up into the kind of resistances. So again, it kind of brings that into kind of full view for everyone. Now, of course, we did break out lower here on this red histogram. So sell pressure did, in fact, mount up and break its kind of pattern that we were seeing. Okay, so we were witnessing bullish divergence, okay, with the price being in lower lows, but the histogram being higher lows. That's now changed. It's no longer bearish divergence that we are seeing here on that kind of zoomed in view, but it is still bearish, also bullish divergence when you actually take a look at it from a zoomed out perspective. We've gone down into lower lows, lower than the low from the 13th of May. And whilst that is happening, this histogram is actually higher low. Okay, so as we kind of span this across multiple days, we can see that that bearish divergence is in fact still there. Right? I have broken it from the smaller zoomed in view, but on the slightly zoomed out view, you can see that it's still bullish divergence that is formed. So another move to the downside could be all that is required here for that next significant break to the upside. So therefore, I am thinking to myself, we have the short position initially taking us down, into kind of a 1.5 risk reward ratio in towards this kind of take profit area. And then once we have that new lower low, I think that is where we want to be thinking long positions. And I think we're going to break out from there. So that's going to be what I'm looking for. I'm going to be looking at, having layered kind of take profits, stop loss that's tight and then moved into green, and looking to kind of ride this and looking for a breakout above its hourly 200 EMA and things like that. Okay, so on the hourly chart, I guess the message needs to be expect volatility, because I think that's ultimately what is going on here. We're just seeing liquidity getting swept from the high side and the low side, from the buyers and from the sellers, from the shorts and from the longs. And I don't think it's going to last all that much longer before we actually have a bigger kind of, short squeeze going on as price kind of moves up higher. Roll this up into a daily time frame. And this move is very much then a bit of an expected one. Okay, we still haven't come fully down towards the 200 exponential moving average, which was our breakout area here, right? We were seeing that the 200 EMA, as you can kind of see here, was heavy resistance from March. All the way through March, it was resistance. We lost it during April. We've moved up. We found it late April as more resistance, got rejected again, and into May, we broke out above it. A retest of the 200 EMA, confirming that it is no longer resistance and is now support, is ultimately what I've been talking about for a little while. And so we are looking for this move, and this next move to the downside that I had scoped out, 71.6 to 72.8, actually falls in line with our 200 exponential moving average, that EMA, coming in at 71.77 cents. So to me, it looks like everything is actually just working its way towards the 200 EMA, looking to turn it into support. Our stochastic RSI almost in the oversold area. So a little bit more corrective action over the next day or so. And we could actually be in a really strong position to see a good rebound when it comes to ADA. The other thing that's worth noting here on the stochastic RSI is how actually this has not been kind of getting worse over time. It's actually been getting better. So you can see here we had a low in the end of March. We then had another low at the beginning of April, another low in the beginning of May, right? And each time it was a higher low. And if we come down, retest around that 30 level, it could be a strong area for support and a good bounce momentum. Of course, momentum is not candlesticks, so don't get too caught up on that. Just an observation that we've seen here. Now, if we turn off the stochastic RSI, bring in the relative strength index, you can see that we're still in bullish territory. We're above the 50 level. Anything lower than 50 is bearish. Anything above 50 is bullish. Although we've had a bit of a correction to the downside, this actually is still looking quite good and pretty healthy. So we could still see this thing turning around and moving back towards the overbought area after a support of the 200 EMA being found. On the MACD histogram, here you can see that we did in fact have bearish divergence. Okay, it was minor, but it was there and we can't ignore it. Basically, what we've got going on is a lower high on the histogram. It's barely there, right? Whilst having a higher high on the price action and of course rejecting down. This is also our fifth wave high. So it was to be expected that we were going to see a rejection from these areas. Now, the selling side on this daily time frame, you can see is really getting weaker and weaker and weaker and hasn't really got a lot going for it. So again, it's looking okay from my perspective. Now, one of the things that I would say is that the price action in itself seems to be kind of short-term corrections and a lot of them being strung together. That's short-term corrections to the upside, short-term corrections to the downside, basically meaning that there's not a trend up and there's not a trend down. It's just bouncing around an awful lot. A lot of people might say it's a ranging market, but actually if you kind of pay attention to the zoomed out view, it's actually trying to toy in with the idea of a breakout of a bullish flag, and that potential breakout could actually lead us into significant highs. The accumulation distribution, you can see that we're sitting on a lot more accumulation right now than what has done previously. So again, I don't think there's a lot of ground for concern there either. Now, as we've kind of zoomed out of this picture here for a little bit, you can of course take stock of the things that we've been talking about over the last few months and years, right? We were calling for 22 cents for the bear market low point. Okay, we were calling for that in 2022. We only got to 23.3, I think, in 2022, and therefore I actually had called that as the potential bear market bottom, only to actually hit my original forecast a few months later in and around June of 2023. Okay, interestingly, we eventually did get down to that level and it was predicted via Elliott wave. That level was a key area where we were looking to find the support. From there, we went into the first distribution event and then the first distribution into first accumulation after the bear market low point. This was actually also Elliott wave predicting the wave one situation, which is your typical kind of people believing that it is a fake move, into the I told you so, I'm not buying it, we're going into new lower lows accumulation. The accumulation was quite obvious. It led us into the next distribution event, which happened up here on this A wave or fifth wave high point. At this point, we did not know that this was an A wave. Okay, that only happened after. Now, at this point, you can see that we had the distribution event for that final fifth wave movement going into the accumulation, okay, down here. Now, this was lower than 42 cents. This was our most recent. And one of the things you'll notice about both of the accumulation ranges is we spent a lot of time in them. Okay, and there was a lot of time spent accumulating ADA. Okay, so this is basically from April 2024 all the way through until November of 2024. Now, that took us into the next distribution event, all the way up here at that $1.35 or $1.32 or whatever it was, right? Up here. Then, of course, the next accumulation zone, right? Now, of course, I was plotting all of these in real time during the events, right? And this is the next one. Now, I not say that we're going to spend a lot of time down here. There's no guarantees that we spend any time down here, right? History tells us that we spend a lot of time in the accumulation ranges. But this time around, we've only spent 2 days down there, and it's been really just a couple of hours in each of them. Now, is it possible that we come back down into this accumulation range and just consolidate down here for a while? Absolutely is, right? That is what historically has happened before, right? And it's interesting to see, right? 2 out of 3 times we've spent a significant amount of time in this accumulation range. But just because it's happened twice before does not mean that it's going to happen again, right? It's all just probability. At the minute, there's a 66.6% recurring chance that we spend a long time down here. And then there's a 33.3% chance that, in fact, we don't. And at the moment, we're in this kind of breakout situation above the 200 daily EMA, which, let's reflect on that for a second, both of these we were not. Okay, so we shouldn't just be sat back thinking there's going to be lower lows and we're going to have loads of time to accumulate, because we have some fundamental shifts that are very different, right? We're above the 200 EMA now, which we were not in the previous two accumulative ranges. In fact, the last time that we broke out above the 200 EMA, we never revisited that accumulation range. Now we've broken above the 200 EMA, chances are we are not going to spend a lot of time down here. So, like I say, trading and technical analysis, it's all about probabilities, and I would say the probabilities are swayed heavy to not revisiting this accumulative range, which means that the next pit stop is going to be basically the distribution range. Okay, let me actually come out of that and show you where I'm looking. Okay, so our next kind of major distribution event is going to be the end of the A wave. Now that A wave is probably going to have to come right the way back up to this previous area of consolidation, which I'm going to be looking at somewhere at just above $2. So I'm going to say $2 to $2.50 is probably where we're going to find the first A wave. Okay, so what we're looking for is this ABC structure that we had before. Okay, and we're looking for it from here. So we're going to have some kind of A wave. I'm going to look for this to be in and around that kind of $2.50 retracement into another accumulative range before moving out into this one here. Okay, now there's lots of different scenarios here that I've got plotted out. We don't know exactly which one's going to happen just yet, but we are looking for corrective patterns to form a diagonal pattern within our larger macro C wave. That macro C wave spans multiple years, right, all the way from 2020. So it's a 5-year pattern that's in play. Now, from this, and I say pattern, it's not pattern so much as it's just tracking the behavior of people, right? The psychology of the buyers and the sellers predicting out that we're going to be in one of these ranges. My conservative is somewhere between $3.09 and $4.77. The median is going to be sat between $5.27 and $12.91, which is quite a broad range. And then you've got that moon boy kind of hopium at $34, which we aren't really going to be talking about. It's going to be somewhere in here, in my opinion, unless, of course, we manage to significantly break out above 1.618 on the fib levels and there's extensions that at $9.48 would trigger a bigger impulsive run. And when impulsive, we mean like the behavior of people just FOMOing in and getting completely euphoric with it, dragging the price out towards these areas is going to be an indication of further continued FOMO and hopium, right? So for now, we're not going to address that. We're just going to be focusing in on, okay, let's see how this A wave goes. The A wave is going to be comprised of a couple of different things. It's either going to be a 5-wave movement, which makes it an A wave, or it's going to be an ABC structure that actually makes it a W wave. But again, that's just semantics, really. The internal workings are really what's important here. So what we're seeing and what we're tracking at the moment is the potential diagonal of one of those movements. It could be the wave 1, the wave 3, 4, or 5, as we kind of think about the WXY patterns. But it's a 3-wave macro pattern nonetheless. So for ADA, I think, yeah, we're probably done with our accumulation range. I would not be expecting us to drop back down lower than 53.95 cents at this stage. So those few hours that we actually spent inside this accumulative range, I think is that. But I don't think necessarily that we're going to be completely done with corrections. We'll have to see if we can hold the 200 EMA. That's going to be the main kind of thing that we're going to watch for the next week or so. But for ADA right now, looking good. I'm not concerned over the things that I'm seeing. I'm expecting further price action to the upside. And so therefore, I think that's going to finish today's video. If you found it useful, smash the like button. If you're new, subscribe. Don't forget to join us in the Discord, and I'll catch you all in the next one.